If you ever hear anyone talk about investing in value stocks versus growth stocks, then you instantly know they have no idea in how to invest. Now, we can talk about this logically, why that is true, or you could just listen to Warren Buffett, who's said many times before that value and growth are inextricably linked at the hip. And of course, this makes sense if we just think about it for a few moments. Anytime you ever value a stock, what you are doing is you are estimating out the cash flows from now into the future. Of course, if a company is growing those cash flows, then there's going to be more cash flows in the future, and thus it's going to be more valuable of a stock. If a company is shrinking its cash flows, or if its cash flows are steady, it's going to be less valuable than one that is growing. That is just common sense. Now, what people usually mean, though, when they're talking about growth versus value, is they're talking about the sort of optical valuation of the stock. What I mean by that is that some stocks trade at low multiples, and so they'll mistakenly call those value stocks, whereas other stocks will trade at high multiples, and they will mistakenly call those growth stocks. Just because a stock is trading at a high multiple doesn't mean it's a growth stock. You can have a stock like Apple, for example, which is trading at around 30 times earnings, which is about a 50% premium to the S&P 500, but it's really not growing that fast. In fact, you could take about a 5-year average of their free cash flow and it hasn't moved much at all. Now, you could take another stock though, like Microsoft, which depending on the exact month that you're pricing it, is growing low double digits to mid-teens and is trading at just a slightly higher multiple than Apple, but there's probably some instances where they were comparable. And so you have this case where there's these two stocks. One is growing more than the other, but the P multiple is the same. Now, of course, it would make no sense to say that both are growth stocks, especially when Apple is hardly growing at all. Now, this is getting right to the crux of the problem when people talk about value versus growth. What they're confusing is the PE ratio for actual financial metrics that matter for the business. Now, if we think about any time we've ever valued a company, of course, one of the biggest inputs to that valuation is going to be growth. And so when people say that they're investing in growth stocks, what they typically mean is that they're buying stocks with very high multiples that they think are going to grow a lot in the future. But it is so important that you understand that just because a stock trades at a high multiple doesn't say anything about its actual growth rate. One has nothing to do with the other. That is kind of like buying really expensive food, thinking that it's going to be healthier and taste better. True, there might be some correlation between the price you're paying for food and its quality, but not necessarily. There are plenty of places that you can go and spend a lot of money and get absolutely nothing in return. And that is similar with stocks. You can see a stock with a very high multiple, and it doesn't mean that it is growing fast. It also doesn't mean that it's going to be able to continue to grow fast into the future. And so what dictates whether or not a company is going to grow a lot has nothing to do with its valuation. Now, I will give you it though that usually if the market correctly identifies an opportunity of a business that is growing very fast, then if you're looking at the P multiple, it does tend to look higher. And why that is so is also pretty simple. If a stock is, let's say, doubling its earnings, then maybe paying 100 times earnings isn't that high. Because we could think about how in next year it's going to be just 50 times earnings, then 25 times earnings, then 12 times earnings, just growing 100% for 3 years. And so that is why you can pay a high multiple for a stock if you have very high confidence in its growth. Of course, though, what typically happens when a company is growing that fast for that long is that it can't maintain it. And so very often investors extrapolate out current trends far into the future and are usually disappointed because it is very hard to grow very fast for very long. Now, of course, there are some companies that can do that. And if you can identify companies that can grow a lot for far into the future, you can say you're growth investing. But you're not growth investing just because you're buying stocks with very high PE multiples. Now, when people say that they are value investing, what they typically mean is that they're buying stocks with low multiples. And so again, people confuse this to mean that these are stocks that are going to be good investments because they have a low multiple. Again, you can buy a stock that has a low earnings multiple. It could be cyclical, for example. There's a lot of auto parts suppliers that are kind of infamous for this, where at certain points in the cycle, they'll trade at 5 times earnings, and then all of a sudden their earnings fall out, and that 5 times earnings jumps up to 30 times earnings or 50, or maybe they're actually loss making. And so just because something is trading at a low multiple doesn't mean it's a good value. So, what I really want you to understand is that the price you are paying for a stock says nothing about these characteristics of valuation or growth. And so, anytime someone says that they're going to shift their portfolio from value stocks to growth stocks, or they're a value investor or they're a growth investor, I can understand and sympathize with what they're saying, because these are kind of common things that people say, and language is tricky and all that. But if you really think about it, it actually makes no sense at all. And so Warren Buffett never says he's a growth investor, and he says he is only a value investor. And that includes, though, when he is buying stocks that he expects them to grow. And that is because growth is going to be one of the inputs to valuation. And so whether a stock is growing a lot or shrinking, the term value kind of already includes both. Because the point of any investor, it doesn't matter what kind of investing you're doing, the point is always to buy something of value. Of course, you want to buy a business that is worth more than what you're paying for it. That is just very obvious. And no amount of growth can ever make up for the fact of you really, really overpaying for a business. As many people found out in 2000 and 2001, when they paid a very high earnings multiple, on the multiple of hundreds for Cisco, thinking that they would be able to grow for so long they could actually rationalize that multiple. Of course, that's not what happened, and for about 2 decades, the stock was flat. Now, I get when people say they're growth investors, sometimes they mean they're trying to look for these new businesses that are disrupting industries. They are growing a lot. They do have many opportunities to grow. The TAM is very big. And so I can sympathize that that is the sort of investing style that you want to do. And there's nothing wrong with that whatsoever. You just have to understand it is not by virtue of the fact that you're paying a very high multiple for a stock that you're quote unquote growth investing. And in fact, if someone called you a value investor, you should be honored and not offended, because a good growth investor is a value investor because they want to buy all of that growth at a good value. It is very obvious. It is very obviously true. And so I would say that there's no dichotomy between value investing and growth investing. And in fact, any smart, intelligent investing at all is quote unquote value investing. But what I mean by that is not that you're buying stocks with low multiples or that have a lot of assets or are net nets, which means that the net current assets are more than the current liabilities and you could liquidate it at a profit. No, none of that is what value investing truly is. All value investing really means is that you valued the business and you bought it for less than it was valued. And if you were doing that kind of investing, then you were basically investing like Warren Buffett. And it doesn't matter whether or not you're buying a stock like Nvidia, thinking that it can grow cash flows for many years into the future, or if you're just buying a bank stock that trades at 10 times earnings and don't expect much growth at all, but expect really intelligent capital allocation in the form of stock buybacks and dividends. Both of those can be value investing, because value investing says nothing about the actual growth of the cash flows. It just says that you are valuing them. And so I hope this helps settle that debate between value and growth investing. If you ever hear anyone using these terms like it's a dichotomy, you can go ahead and discount everything else they're going to say thereafter. But if you want to become a better value investor by really understanding what valuation is, make sure you check out this video here, where we really get into more technically what's happening when you are valuing a stock. And if you enjoyed these videos at all, go ahead and hit like and subscribe. And please feel free to drop any questions you have on this topic or any topic in finance investing in the comments below, and I will answer them in future videos.